All right, well, the market story as we wrap up the week has been one with momentum. I know the TSX at this hour is softer, in part because of some selling in the material stocks. But remember, yesterday we saw a fresh record for the Canadian benchmark. And over the last 8 days heading into today, you'd seen some strong performance. Tech and industrials were the big winners. And what's interesting is the reversal of the weakness we had seen heading into and in and around Liberation Day, all the trade worries that are still front and center for Canada overall. But the TSX now up close to 5% on the year after having been down 9% at its April low. Let's get some more perspective on the mood of the markets. Dan Rohinton is a portfolio manager with IA Global Asset Management. Dan, it's nice to see you. Thanks for joining us.
Good to see you.
This is it's a Friday heading into a Canadian long weekend, so perhaps a moment of pause to reflect upon what has been happening. What's been your perspective on the market moves recently?
Yeah, so in the most recent, call it month or so, we've seen basically a revival of some of the, call it the risk on more macro sensitive sectors. So we've seen financial services, industrials as an example, and energy to a different extent as well. Also really just drive the performance. So what was in the prior months a gold-centric, material-centric rally has broadened out into areas like technology, which frankly is mostly Shopify. And then the rest is really financial services, which is macro risk on, and then consumer and industrials, which broadly speaking would be the same thing. So the Canadian market is catching up to the same dynamics that have been driving the US market of late.
And, I was mentioning that things got a little tentative in the Friday session after we saw some slightly softer consumer sentiment numbers in the U.S. But in your opinion, where is the mind of the markets? You have to factor in lingering trade uncertainty. Obviously, the easing of tensions has given people a little more confidence to step in and buy. But we've heard from a lot of companies that are cautious on what the trade uncertainty means for their business. We're not quite sure what central banks are going to have to do. So where is the mind of the markets right now? Is it looking through those considerations?
I would say so. I think maybe a little bit too much so. So I think what we are seeing is that the market is looking at all the incremental data points and what was as recently a month and a half ago viewing it with a very negative light and taking everything that Trump was doing at his word and then extrapolating it forward. Now it's moving in the other direction where the positive data points are skewed there. So I think it's potentially a situation where the market might be a little bit too aggressively pricing in the benign outcome.
Now, what ultimately happens in an environment like this where, S&P was getting close to officially entering a bear market, didn't get there. We got back into our bullish ways, but it's feeling like an M&A Friday. Sometimes we talk about M&A Mondays. I talked about what's happening in the Canadian energy sector. Very exciting story involving MEG. In the U.S., we haven't even had a chance to talk yet today about a big cable tie-up with Charter agreeing to combine its operations with Cox. Maybe businesses that are a little less known to Canadians, but that's quite a tie-up for two big cable players. Do you think that in part is influenced by where we are in the market cycle and the general mood of the markets?
I think Cox Communications and Charter coming together is a bit of a slightly different conversation, but broadly speaking, I would agree with you that we've seen a lot more term sheets, a lot more capital being raised more recently. But to double click on the Cox transaction, because it is by far the biggest one that I've seen come through the desk this year, it really comes down to what's going on in the US cable market with the idea of convergence, where the telecommunications, call it the handset mobile companies competing more on cable, and cable companies offering more bring your own device plans and competing more with the telcos. So that convergence has led to more competitive intensity and what's known as overbuilding in the sector, and also just different levels of pricing discipline being lacked at the margin. So what we are seeing as part of this is a major family-owned company that's been in the business for 50 years, merging with the second largest cable operator in the United States, to create something that is basically akin to where Comcast is today, minus the media business. So this tells you that it's a little bit defensive, but given the nature of what it is, they're wringing together the synergies and basically becoming a more formidable competitor to the telcos as well. But this is a symptom of markets that are conducive to this type of transaction. Because if this was a month ago, I seriously doubt that this kind of transaction would go through.
Fair point. Hey, speaking of deals on a smaller scale, but symbolically very interesting, a lot of headlines around Canadian Tire acquiring the Hudson's Bay brand assets. Obviously, a lot of people were wondering what was going to happen to the HBC brand in light of the sunsetting of the business. So they're paying $30 million, but they're going to get the iconic stripes and the logos. What did you make of the news?
I think this is when we're zooming from the $30 billion transaction to the $30 million transaction with Hudson's Bay. It just tells you that we're at the end of an era when it comes to department store retail. So Hudson's Bay is older than our country, and it's a testament to the longevity of the company for navigating so many different environments. But we are reaching the twilight of the department store era. And that's really what this was Canadian Tire picking up potentially a few locations, depending on some of the nuances of the story there, picking up some of the brand and the IP, which has resonance in the Canadian market. But Hudson's Bay, I apologize. Hudson's Bay will never show up in the same way that it did during my childhood and yours. So this is the sign that the department store era is over. Canadian Tire, which has its own, call it, idiosyncrasies that do go on, it's become kind of the home for, call it, stranded brands in the Canadian market, whether it's Toys R Us, whether it's Forzani Group, which is Sports Check, and now it's Hudson's Bay. It scoops up what's going on in retail. But the big story in retail in Canada and elsewhere is e-commerce, and the role that Walmart and Costco play in growing stores domestically. That hurts the local players, including Canadian Tire and including Hudson's Bay once again.
Yeah, it's a fair point. We're going to take, Dan, a quick break. Want to come back and just talk to you about some stock ideas. Dan Rohinton is with us, and we'll continue to talk about the investing landscape. Keep you posted on the markets on this Friday morning. You're watching The Open.